Welcome back to the Seven Figure Annuity Sales Podcast. It's Caleb North here with you today, and I've got a few good topics for us to talk about today that are loosely related, but mostly unrelated. We're going to talk about index rate comparisons. We're going to talk about Roth conversions and kind of a different strategy that you can use for that. And then we're going to talk about something that came up this week that I found interesting. That I'm not going to give too many details on now, but we're going to get to that in just a little bit. So the first thing I wanted to talk about today was actually something that I had some questions on from agents this week. And it was really about trying to figure out what am I going to allocate to? And if you guys recall, I did a whole podcast on index allocation. So I'm not going to go into that much depth and detail today, but I'm going to share with you guys an idea or a thought when it comes to index allocation. And to set the stage for that thought or that concept that you guys can employ, I want to just reiterate kind of my preferences. I know that we're in an environment right now where silver's gone crazy, gold's gone crazy. We've had our commodities just absolutely booming. And I love it. I think it's awesome. But I also can look at charts over time, the history of performance, and see that on average, over the long term, equities tend to outperform commodities. So my encouragement would be don't necessarily buy into the recent boom of commodities and start using commodity-based indexes as kind of the sole allocation that you're putting clients into in these products. That's a conversation that you should have with your clients. But when it comes to those indexes, personally, I'm still a big fan of the simplicity, the story, the recognition, the household name of the S&P 500, and the fact that it's purely equities. And it's in what we consider an unmanaged index from the standpoint of it's not volatility controlled in the index itself. So with that tends to be my personal bent and preference is toward the S&P 500 when I'm looking at index allocation within these products. And most of the time, you're going to have a cap option there, which, by the way, when you're comparing rates from one product to another, don't compare arbitrary indexes and their rates. Compare the same index in the two different products. And the common ground across the board mostly is going to be the S&P 500. Pretty much every index product out there is going to have the S&P 500 in some way, shape, or form. And then what you try to do is find the same crediting method, the same point-to-point period, so the same reset period, and the same limiting factor. So I wouldn't compare an S&P 500 two-year point-to-point par rate with the S&P 500 one-year point-to-point cap. Okay? What I'm going to do is I'm going to compare the same strategy, so the same index with the same crediting method, the same reset period, and the same limiting factor. So that means I'm going to compare the S&P 500 one-year point-to-point with a cap to the S&P 500 one-year point-to-point with a cap, or whatever it might be. But don't go comparing multi-year reset periods with a single-year reset period. Don't go comparing, monthly average to par rates and caps. Like you've got to try to keep all of that consistent in your comparison. But what I like about the strategy is that most of the time, indexed products are going to have an S&P 500 cap on an annual point-to-point. Like that's going to be in 90 to 95% of our products. So you have a pretty solid baseline of comparison. And the reason that it's good to compare that, the other thing you can compare is the fixed rate in the product as well. But generally speaking, these products are going to have the same budget for their options. Okay. So what I mean by that is if I'm looking at one specific product and the carrier say they have a 2% options budget, that 2% options budget is what they're leveraging to create the rate for the S&P 500, as well as all their fun new volatility controlled indexes that I would caution you to be wary of. the budget is the same in the strategies. So if you can compare a common grounded index with the same reset period, the same limiting factor, the same crediting method, all of that, to the same strategy in another product, it gives you a baseline to see, okay, if I'm getting a 10% cap on the S&P 500 here and I'm getting an 8% cap on the S&P 500 here, I've got a 20%, it's 25% better in the first option. What that should equate to is about a 25% better rate on the other strategies available that you can't necessarily compare apples to apples. So that's one thing I would recommend that you do. The next thing I would recommend that you do is consider mixing up in an allocation, not like mixing up the crediting method and the limiting factor that you're using. Personally, I'm pretty hung up on 1 year point to points. Like I can see the advantage of 2 year point to points from a rate standpoint, but the only time I would do that is with like a portion of the funds. Like say you start a contract and you split, 50% in an annual point to point so that you can credit something, hopefully at that first policy anniversary. And then the other 50% is in a 2 year. And then what you do is after that first policy anniversary, the half of the funds that's allocated to the 1 year point to point, you move that into a new 2 year point to point. So then what you end up with are all of the funds in a 2 year point to point strategy, but they're crediting every other year. And so that's really the only time I would use personally a 2 year strategy, because I think if you only allocate to a 2 year strategy, it's going to be pretty deflating to clients on an annual basis, waiting for that second year to finally roll around. The other thing, you can miss a lot of dip and recovery over that time, and you can kind of flatline too. If you have a nice 2 year hill, if you will, in the market, you can hurt your upside there. So I know rates are better on 2 years. Personally, would recommend the 1 years. That being said, a lot of times you have different crediting methods. You've got monthly average, you've got monthly sum, you've got monthly caps, you've got annual caps, you've got participation rates. And the most common two that I'm seeing is your annual caps, 1 year point to point caps on the S&P 500, and then your annual point to point participation rate on the S&P 500. And I was having a conversation with an agent. He was trying to figure out, well, which one should I pick? And my thought was, well, in this case, why not split it 50-50 between the two? And here's the logic behind that. And this is not going to be revelatory for some of you, and this is going to be extremely profound for others of you. But if you think about it from an upside potential standpoint, your cap is always going to credit you more when the index is positive but moderate. Your par rate will typically credit you more when index just goes on an absolute boom for a year. Okay? And there is a teetering point of when the participation rate becomes better than your cap. And it's calculatable. So I'm going to use easy math for you here so you can track along with this. But essentially what you're going to do is take your cap rate and you're going to divide it by your participation rate. So let's say, for example, these are going to be rates that you can find in products right now. Let's say I've got a product that has a 10% cap. What I'm going to do is I'm going to punch 10 in my calculator, and then I'm going to divide that by the decimal representation of the par rate in the same product. So if I have a 10% cap, 1 year point to point cap on the S&P 500, and in that same product, let's say I have a 50% participation rate, a 1 year point to point par rate on the S&P 500. I'm going to take the 10, divide by 0.5, because 0.5 is the decimal representation of 50%. What I get is 20. That's the number that comes out on the calculator. It's 20. That means that 20% is the index performance threshold that teeters one side or the other to be in favor of a cap strategy or a par rate strategy. So what that means, anything above 20% in that scenario the participation rate would credit more interest if it's a 50% participation rate. And what that also means is that anything less than a 20% return on that index, the cap would be a better strategy to use. And you can calculate this out by taking that 20% and then multiply it by your par rate. If the index did 20%, what do I get from my participation rate? I get 10. What is my cap? 10. They're equal at 20% return on that index. That means anything above the 20, the par rate's better. Anything below the 20, the cap is better. Well, then what you can do is you can cross-reference that index threshold, 20%, to what do I reasonably think the index is likely to do? And please hear me out. I am not recommending you speculate what the market's going to do. What I like to do is look at the historical annual returns. Now, I know in our annuities, we're dealing with different point-to-point periods, and it's going to look a whole lot different than just our January 1 to December 31 annual returns that we look at all the time on the S&P 500. But the point is, that's what I look at. So then you can, I can tell you that, let me get this pulled up, but I believe it's like 4 out of the last 7 years. It's been over 20%. 1, 2, 3, 4. Yeah, 4 out of the last 7 years. That's not counting, well, it is counting 2025. I just can't remember offhand what 2025's annual return was. But let's just say, for argument's sake, it's 4 out of 7. The index has returned over 20%. Okay. What that means is that if you want to get real granular, you can figure out what percentage of the time that is. That's 57% of the time. And you could allocate that percentage to the par rate. So if we know that 20 is our threshold and we look back and we say, okay, well, X percentage of the time the index has been above it, let's say over a 10-year period, X percent of the time it's not been, then you can use that to calculate your allocation percentage. An easy way to do it is just a 50-50 split at the 20% threshold. But here's the other thing I've seen in products. I've seen times where the teetering point, that percentage of teetering, is like well into the 20s, in which case your par rate will rarely be your better strategy, in which case you should allocate most, if not all, to the cap. And vice versa. I've seen it to where the teetering point was super low, is like, mid-teens. And that's not a low return. It's just to say that when you look at the last 25 years, for the S&P 500 to go do 15% in a year, you probably want to put more in the par rate in that scenario. So you can use that teetering point to help you decide, how am I going to allocate? And it works really for any 2 index strategies that are on the same index itself. It doesn't, that methodology doesn't work real well when you're trying to allocate between multiple indexes. That's a whole nother conversation on picking between different indexes. But again, I'm coming at this through the lens of, I like the S&P 500. It's a household name. It's what people synonymize with, quote unquote, the market. And when you look at averages over time, I'm not talking about outlier years where silver goes on an absolute tear. I'm talking about averages over time. Your equities tend to be better performers. That's just the way it's been. So anyways, that's one thing. I do want to talk a little bit about Roth conversions as well, which is unrelated. And hopefully you guys were able to track with that last part a little bit. And if you need to replay it, then certainly replay it. But Roth conversions are a conversation that has really come up a lot, and I think for good reason. But I also think there should be some caution around it. So Roth conversions are relevant to people because in their minds they don't want to pay taxes. Well, the essence of a Roth conversion is that you're taking qualified money that's grown tax deferred, and you are converting it to Roth, which is tax-free. And the only way to do that is to pay the taxes on it. So I want to be very clear that the essence of a Roth conversion is I'm going to do the thing I don't want to do. It's like if I don't want to pay taxes on this money, then I'm going to choose to Roth convert, which I am now having to pay taxes so that I have tax-free dollars. You're doing the very thing that you're trying to avoid. That doesn't mean that Roth conversions don't have a place, but that cognitive mapping, that thought process should help you and clients realize that it's not for everyone. Please understand that's what that is happening. That's what's going on. If I've got $200,000 of qualified money and I decide I don't want to pay taxes on it, the only way I get that to Roth is if I pay taxes on that money. So I'm doing the thing I'm trying to avoid. Because that's the reality of the way that it functions, I want to be clear that it's not for everyone, but you need to assess who is it for. Does that strategy or does a Roth conversion make sense for this individual? Work with CPAs if you need to. And then really, really, really consider avoiding lump sum conversions. We have products now that allow systematic conversions that can save clients points of, literal percentage points, numerous percentage points in taxes. So I want to give you a scenario here. The current 2026 tax brackets for joint, couples filing jointly, are 10% up to the first $24,800 in income, and then 12% up to the first $100,800. Okay. So I want to beg just for the ease of argument here, that we have a couple whose earned income is $100,800. What that means is that anything above that $100,800 is now being taxed in the 22% bracket. And that one stops at $211,400. If you have somebody that's earning $100,800, that's their earned income, and now they're wanting to convert, you're dealing with a situation where they're going to be bumped into the next bracket on what they choose to convert. Now, I'm not saying it still can't be reasonable, but what I would like to contrast that idea with is somebody earning, let's say a couple earning $80,800 a year. So now they're $20,000 shy of that next bracket threshold. And let's say, for argument's sake, they have $200,000 they want to convert. Well, rather than doing a lump sum that's going to put $180,000 of that $200,000 into a bracket that is 10% higher or more, and the next one up from 22, I believe, is 24. So it's either 10 or 12% more. What if you did a systematic conversion where you convert $20,000 this year and you stay under that $100,800 threshold so that all $20,000 of that conversion is taxed at their 12% threshold instead of the 22? And then what if you recalculate that every year to figure out what can I reasonably convert this year to stay in this lower bracket and save myself numerous percentage points on taxes on the conversion? That's my recommendation. If you're going to do a Roth conversion, seriously look at a systematic conversion. And we have carriers and products that will do that. We have carriers and products that you can issue the IRA contract and then do an internal systematic Roth conversion inside the policy that literally goes to a sister policy that is fully Roth. And it has the same rates and benefits and everything, all the contract details of the original policy are the same. So that's my encouragement when it comes to Roth conversions. That one's pretty quick and short. And then the last one I want to talk about is a story that something came up this week. And I can't go into a ton of details, but basically what it was an IMO misrepresenting how to use a product. And it would have been mathematically advantageous for the client and the agent and absolutely disastrous for the insurance company, the way that this math would shake out. And I saw marketing that this IMO was recommending agents to use it this way. And it's just a little sketchy. It's a little bit not cool. I'm not trying to be casual about it or elusive about it, but here's what I'm going to say. Use the right product for the right solution for the right individual. There are ways that you can correctly and wholesomely leverage policy benefits for the client, but make sure that you're using the right product for the right solution for the right client. In other words, don't be recommending the wrong product for somebody that's looking for something else just because the one product you might want to sell could be internally manipulated to function in a way that's similar to what they're actually needing. Like, use the right product for the right solution with the right person. And I'm going to leave it that vague because I don't want to disparage anyone. I think it was a creative solution that I saw, but it was also a sketchy solution and quite literally could be, from an actuarial standpoint, devastating to an insurance company, the way that they were leveraging and recommending the product be used. So I say all of that to make a point, not to make anybody look bad or sound bad or whatever, but to make a point that you should be using the right product for the right solution for the right client. And I know that in our podcast listeners, I'm probably preaching to the choir in that regard. You guys know how we operate. It's all about ethics. It's all about integrity. It's all about doing the right thing, even when nobody's looking, even when you don't maybe have to. We believe you do. And so you know who you're dealing with here at Retirement Realized, and we wear it on our sleeve. And that's an encouragement that we're always trying to make agents aware of and help you guys with, is writing more annuity production, but doing it with ethics and integrity. Clients first, agents second, IMO and insurance companies third. That's the way it should flow. That's the order of priority. I hope this helps you guys. And as always, happy selling.